Danny from Wicked Cool Finance here. What is a dead cat bounce? What is a short squeeze? I watch a lot of financial channels. I'm a financial guy. I actually was a financial advisor at one point in my life. And so I enjoy watching the financial channels, such as CNBC or Bloomberg. Very interesting though. And watching those channels, the commentators use a lot of very interesting terms. They use terms like dead cat bounce. They use terms like long, but they use the word long in a very different way than we typically do in the English language. They use the word short, but again, in a very different way. They use all kinds of terms. It gets very confusing at times. And in fact, sometimes I think half the commentators on the financial channels don't know what the other half of the commentators are talking about. Well, what is a dead cat bounce? A dead cat bounce is an unsophisticated term for a more sophisticated term that is called a short covering rally. Okay, well, we'll dig into that in a second. Question though, can you lose more money? Can you not make? Can you lose more money in the act of selling a stock versus can you lose more money in the act of buying a stock and holding it for the long term? It's a trick question. The reality is you actually can lose more money in the act of selling a stock, and we'll dig into that in a second. Well, let's talk about that term, going long. On the financial channels, you'll often hear, especially on a Friday, you'll hear a financial advisor say, I don't want to go long the market over the weekend. Well, what does long mean as it relates to stocks? Financial advisors don't want their clients to be concerned with the ups and downs of the market. They want their clients to be long-term investors. And so, over time, that word long has become synonymous with buy. So when an advisor says, hey, let's buy Coca-Cola, for instance, another way that they would say it is, let's go long Coca-Cola in an effort to entice you to hold that stock for a long period of time. Okay, let's dig into it. What is shorting a stock? Well, many people think that you actually can make a lot of money when stocks go down. Here's the reality. The stock market's been around for a long time, and over that long period of time, on average, how many days a week does the stock market go up? And then on the flip side, on average, how many days a week does the stock market go down? The reality is, the stock market on a typical week goes up 4 out of 5 days. It goes up most of the time. But when it falls fast. So as I said, many people, because it falls fast, many people think that you can take advantage of that, use that as an opportunity to make some money. How do you do that? Well, let's use Coca-Cola as an example. Let's say that Coca-Cola is $100 a share. Well, how do you short Coca-Cola? What's that mean? When you short a stock, what you do is you call up your financial advisor, maybe at Morgan Stanley or Merrill Lynch, or you use a firm like E-Trade or Interactive Brokers, Betterment, Robinhood. These are all great firms. You call the firm up, whether it be with a financial advisor or not, and you tell them that you want to short Coca-Cola. What they would do is they actually would lend you Coca-Cola. All right, so let's say Coca-Cola is $100. They lend you Coca-Cola, and they expect you to give it back. So they lend it to you at $100. You sell it for $100. Now, 3 or 4 days later, let's say that the stock falls to maybe $90. Well, it's time to repay your loan. You sold it for $100. Now you buy it back for $90. What happened? You just made $10 a share. So you actually can make money when stocks go down by shorting them. But you have to be careful. I say, don't ever short a loan, okay? Back in 2001, there was an extreme case. You may remember the firm, they're still around. You may remember the company called GameStop. GameStop bought and sold, more so sold, video equipment and video games. Well, as you know, very similar to Blockbuster, we don't rent movies anymore. We watch movies on Netflix or we stream them on HBO. Well, in the gaming world, we don't buy gaming equipment, or we don't go to the store and buy games. We get a gaming console and we download the games and we play the games on our TV. There's really no need to go to GameStop anymore. Well, back in early 2001, Many large financial firms, very sophisticated firms, kind of pulled together and realized that GameStop may have run its course. And many firms on roughly January the 1st of 2021 shorted GameStop. So they borrowed the stock, they sold it hoping that it would go down. And I thought it would go down too. However, there was a group of people that got together on social media, on the internet. And they learned about these financial firms and what they were doing to GameStop in shorting it. Because when a lot of people short a stock, it does typically tend to fall. But in this case, the folks on social media got together and they said, hey, let's show these sophisticated firms how smart we are. So they got together and started buying GameStop like crazy. And over about a 20-day period, about 20 to 25 days, GameStop took off. It started at roughly 17, about the very beginning of January in 2021. And by January the 21st, 23rd, roughly, it had risen to 483. That's a 1,700% gain. So you have to be careful, because if you think about it, let's come back to our Coca-Cola example. Let's say that we borrowed Coca-Cola, we sold it for 100, and then Coke took off. Well, Coke's a great company, right? Well, let's say Coke went from 100 to 150 to 200 to 300. Well, if you sold it if you sold it and you have to give it back, and you sold it for 100, and now the stock's at 300, well, you'd have to buy it back at 300. You could lose 200. Whereas if you buy a stock for $50, well, let's use Coca-Cola's example. If you bought Coca-Cola for $100 and the stock goes to zero, how much can you lose when you buy Coca-Cola for 100? Well, $100. Whereas if you short it, you borrow it, you sell it, and the stock takes off and never stops, the amount of money that you could lose could be infinite. So be very, very careful. Well, let's come back to a normal environment and revisit what is a dead cat bounce. No, financial advisors aren't throwing cats out the window. What is a dead cat bounce? Well, in typical fashion, as I said, people often band together via social media or other ways, and they will decide in a group to short a company. And when they do that, oftentimes the stock will fall and fall quickly. And when it does that, what happens is a dead cat bounce. Those people got together, they borrowed the stock, they sold it, it fell. Now they're ready to realize their gains and buy that stock back and pay the loan off. And so when they buy it back, the stock turns around and goes right back up, but they just made their money because they sold it when it was lower. That's called a dead cat bounce. Pretty cool, right? Like and subscribe. Thanks a bunch. We'll see you on the next video.